Hello and welcome to Livewire Markets Fund in Focus. My name is Chris Conway. Today we're going to be talking about one of the recent success stories in the Australian listed income market, the Stonepeak Infra One Notes. This product raised $300 million in just 2 days and is going to be available for investors on the ASX on December 10. Joining me is Andrew Robertson. Andrew is the Senior Managing Director and Partner at Stonepeak Capital. Andrew, thanks for sitting down with Livewire today.
Yeah, thanks, Chris. Looking forward to it.
Congratulations on the recent successful launch of the Stonepeak Infra One Notes. Just in a nutshell, can you explain to the audience what they're all about?
Yeah, certainly. So Stonepeak is actually the world's largest independent manager of infrastructure assets. And infrastructure as an asset class, we think, is a fantastic fit for income-oriented investors. And so we're taking what is effectively an institutional product historically and bringing that into a context that's available for individual investors here in Australia. The notes, in some ways, are fairly simple. They pay a monthly income of BBSW plus 3.25 for a period of 7 years, and they are listed on the ASX.
Andrew, let's just take it up one level. Stonepeak, it's very big globally, but there might be some Australian investors that are less familiar with it. So just give us a little bit of background about Stonepeak and the journey that company's been on.
Stonepeak's one of those great Aussie stories, I think. It's sort of our current CEO is also the founder of the business. He was a long-term Macquarie and then Blackstone guy, moved across and saw an opportunity in the US about 13, 15 years ago, and stepped out on his own, set up a asset management platform, which has then since just blossomed. So it's now has 115 billion Aussie in assets under management globally, 350 odd staff. And we serve, a whole range of the world's most sophisticated and largest institutional asset managers. Institutional investors, I beg your pardon. The majority of what we're doing for them is providing them access through to infrastructure assets. One of the interesting things that's really happening for us, one of the areas of fastest growth, is actually while our historical clients have been institutional, we're now seeing real growth in serving and delivering through to individual investors this asset class, which was previously the preserve mainly of instos.
Andrew, infrastructure, it's pretty hot right now. It's pretty important right now. As you would well know, Aussies love their income, right? But how does Stonepeak define infrastructure? And then give us some examples of what's in the portfolio.
We think of infrastructure, in four broad buckets. So we look at transport and logistics. We look at digital and communications, energy and the energy transition, and we also look at social infrastructure. And so within the portfolio, we've got great examples of each of those assets, and actually we've got sort of blue chip Australian infrastructure in each of those areas. So for instance, in the transport and logistics space, we've got a number of operating toll roads that'll be very familiar to people, things like Eastern Distributor and WestConnex. We've got major airports. We've got Canberra Airport, to the extent you can call that major, I guess, but it's certainly major for me as a Canberra boy. And we've got airports throughout Queensland. In the digital and communication space, we finance and we've got exposure through to a number of the cell towers that actually sit there and carry the cell signals on each of our phones. And we've also got exposure to some of the largest data center platforms here in this country. Energy is a huge opportunity set in infrastructure, and in energy we're biasing towards some of the utilities. So we've got businesses like Transgrid that we're exposed to in relation to, for instance, their transmission line assets. And then in social infrastructure, it's potentially some of the stuff that you might not think about as much in terms of just instant recall or instant sort of pattern recognition on infrastructure. Really interesting assets though. Some state governments, for instance, have outsourced the provision of licensing of cars and trucks, etc., and provided them on very long concessions to investors who operate those under PPPs. In those circumstances, very, very stable, attractive assets.
Yep. Andrew, I just want to pull on a thread there. You talked about long concessions and all, as you were going through the different buckets and the assets that you own, really long life for these assets, isn't there? And oftentimes prices are regulated like the toll roads. So you're going to get that consistent return, which you can then distribute back to investors. How critical is that for your process?
That asset intensity, that long life, the consistent cash flows, All of those factors mean that those assets are somewhat removed from the normal vagaries of the macroeconomic cycle. We love that about infrastructure. It's why institutional investors love it about infrastructure. But in this particular product, we go even a step deeper because we're not buying the equity in those infrastructure assets. No. We're getting exposure to the debt and to the credit. So that is just a natural flow of underlying income coming from those assets, which we then think is a very, very neat match against what is our obligation, which is coming back and paying income on time and in full through to the note holders.
Yep. Just for a rookie, Andrew, take me a bit deeper there. The debt versus the equity. What's the feature and benefit of each of those?
So if you think about this capital stack of a normal company, and infrastructure businesses and are companies in that sense as well. Obviously the volatility of those businesses, the variations that you do get from time to time in the revenue profile, that'll hit the equity returns first. And so the debt, while all of that noise is going on, the debt still needs to be paid. It needs to be paid on time every single quarter or month, whatever is the underlying terms of that debt that the infrastructure business has got. That's the exposure we've got. So we've got coming into the issuer of the note, we've got a steady stream of income. So then that allows us to take that and pay out to the note holders an equally steady stream of income.
Andrew, talk to me about how you access these investments. There's plenty of infrastructure, but you got to know the right people and have the right opportunity to deal. So how do you get access to some of these bigger projects as well?
Yeah, look, we've got a wide range of different strategies there, but let me just sort of summarise it in 3 high-level buckets. So the first of those is that we see huge opportunities in the infrastructure debt that banks already hold. Now, as a major player in the infrastructure space, the biggest infrastructure banks come to us as a strategic partner. Oh. And as those banks have been very successful lending, they've had very low loss rates, but the new capital rules called the Basel Accords make them hold very significant capital against those assets nonetheless. So we partner with them. We're able to then help provide them structures that release that capital. We, in turn, can choose from their balance sheet those assets which we believe to be the best assets that they're holding, the ones that they want to hold, not sell. And in addition, we're also getting paid by them more for the capital we're helping them to release than the risks we're taking. We like that fact pattern. Second group of opportunities is in what we call private infrastructure credit. So private infrastructure credit is situations where the infrastructure businesses have got a situation where the bank's natural constrained rules mean they're not able to be flexible enough to help. They come to investors and to lenders like ourselves, and we're able to provide for them solutions to help them move through. For instance, a lot of these assets are owned in an infrastructure fund. They might need to be rolled from one infrastructure fund to another. It might take longer to do. That's a natural opportunity to provide a bridging debt product. That sort of product can be fantastic returns for attractive risks. And then finally, while the infrastructure is very much the hero of the story on this infra note, 70 to 90% of the assets we tend to look for to be infrastructure, of around about half of which at least we want to come from Australia and New Zealand. Despite that, we're also then looking through to what we're calling diversifying assets. Those are assets in opportunities like asset-based finance and corporate lending. And we're using them, for instance, to achieve things like making the liquidity of the portfolio work. So when we have a note redemption, it can be helpful to have those type of assets to match in the liquidity of that obligation.
Andrew, another question without notice. Infrastructure projects, how many do you look at a year, run due diligence on, and obviously some end up making it into the portfolio?
Yeah. Look, a lot.
Yep. Okay. So that's really the reason for the question, because exactly, the rookie would think there's not that many big infrastructure projects out there, but it sounds like there's
as an example, when we're working with the banks, I mentioned before that we work with them on these portfolio trades. A recent trade that we've done, we spent 4 months looking at one of the bank's portfolios. They gave us a list of 150 assets, 150 debt assets.
Okay.
We underwrote all of them, or we went through all of them. We've passed our way through, and we ended up selecting 49 out of those 150. And to do that, what we're doing is actually picking on all of that expertise that sits in the 350 experts that Stonepeak's got globally, experts in data centres, experts in energy and transport and in social infrastructure. And we're able to then come back and to quickly get to the heart of each one of those things to scan through at a high level. But then once we're actually looking at the assets that we want, we go very, very deep. And so we're looking hard at what those assets entail. An important thing about this Infra One note is that the investments that we make, we're taking the first loss on them. Right. So to the extent that we make a mistake, we're wearing that mistake from dollar one. And so that means that there's a very, very intense focus. This is the partner's money at risk in terms of these types of products. Very intense focus on making the right decisions and making it, being really intentional in the way we invest.
Andrew, there's been a few other listed note income products launched earlier this year. Tell me how Stonepeak's offering is different.
Yeah, look, there's a lot of similarities to some extent. I think actually as an industry, like we can be sort of proud of this. This is a bit of an Aussie innovation for that sort of, and I mean, hats off to some of our predecessors here. It's an interesting sort of a product. And similar sort of structure. This is a listed note. People can buy it on the ASX. The idea is that it pays a floating rate plus 3.25. That's at the moment, that would be just shy of 7% per annum. And the payments are backed by a pool of underlying debt instruments. And because it's got a fixed term, the note, it does a good job, we're seeing at the moment, does a good job at trying to maintain the value of that note, at and close to par, has been some of the experience that we've seen to date. So a lot of things there that are attractive. Now, one big point of difference for us is our focus on the collateral that underpins that note structure being in the infrastructure space. Now, people will be familiar with the focus that ASIC's got at the moment on the private credit space. One of the big findings that they've got there is that they're, I guess, noting maybe a little bit perturbed by the fact that so much of Australian private credit is commercial real estate and commercial real estate construction focused. That is completely off the table for us in the context of this strategy, and our primary and dominant focus here is into the infrastructure debt space.
Andrew, perhaps the most important question I'm going to ask you: how do investors find out more about the note?
Yeah, well, they can come to our website, stonepeakplus.com.au. And of course, ask your advisors as well. So, this is a product now that advisors, I think, understand well. And hopefully, this is a delineation and an interesting point of difference for this product with the underlying collateral. That is, great ways to find out more.
Andrew, thanks for taking us through the note, and congratulations again on the launch.
Good on you, Chris. Thanks. Cheers.
The Stonepeak Infra One notes will be trading on the ASX under the ticker SPPHA. Available on the 10th of December on the ASX. If you enjoyed this Fund in Focus, make sure to give it a like, and don't forget to follow our YouTube channel. We're adding lots of great content every single week.